Morning, everyone. As just been introduced, my name's Harry Edis. I'm delighted to be joined by some very eminent colleagues on the panel today. To my immediate right, there's Robert Sams, who works at Climatics. We've got Gary Chu from UBS and Paul McCormack from HSBC. And I should just apologise if you were solely coming here to see Kashaya Somasundaram. Unfortunately, she wasn't able to make it today, but Paul is a very able deputy to sit in. So, as discussed, we're here to talk about central bank digital currencies. Just a couple of notes. We're not going to be the views that we articulate are certainly not going to be representative of how central banks think about this. We're just trying to give you an idea as to what the CBDCs are and how we might see them sort of implemented at some point in the future. But clearly there's a lot of central bank policy behind all of this, which we can't really comment on. But fintech is clearly giving a huge opportunity to the market. Some might say a generational opportunity to improve one of the core building blocks of the financial services system. And so hopefully we'll give you some enlightenment on the CBDC market. So I think to start with, let's actually just ask a more fundamental question of what is a central bank digital currency? So Robert, would you like to take that one?
Sure. I mean, I guess the answer to that question is at the first as what a digital currency is. And there is no accepted definition, and the meaning of it has sort of evolved over the last 15 years. But a digital currency is not just electronic money. It is a form of electronic money that replicates a lot of the properties of physical cash, being a bearer instrument, potentially having the ability to transact anonymously or pseudo-anonymously. But the bearer nature of the digital cash instrument is what makes it different from other forms of electronic money, which are account-based money. What a central bank digital currency is a digital currency that is issued by a central bank. And why that matters is that there is a fundamental distinction between central bank money and commercial bank money. And we're talking about fiat currency here rather than cryptocurrency. And most money, the vast majority of the money supply is commercial bank money, which is a liability of a private commercial bank, and it contains credit risk. It's an unsecured loan to the commercial bank. Central bank money is a liability of the central bank, and it does not have credit risk because a central bank, by construction, cannot default on its liabilities because it's fiat currency and its liabilities are irredeemable. So these two forms of money in our monetary system is devised in such a way that they are fungible one for one, but they are actually different forms of value and play. And the central bank money piece of it plays a very special role within the capital market system.
Thanks very much for that, Robert. So just sort of playing on that theme a little bit around this difference between cash and bank deposits. Gary, how do you see this and how does it play into the system?
Sure. So this is probably going to rehash a bit of what Robert has said already, but with physical cash, we're all very familiar with it. We would view it as a value-based form of money in the sense that it was historically backed by real assets, such as gold, but is now backed by government decree or guarantee. People love physical cash because it's risk-free, it's central bank issued, it's immediate in the sense that if I want to use my £10 note to buy a coffee, I hand it over and there is immediate settlement. And it's also anonymous, so I don't have to reveal my identity to who's selling me a coffee. So that's physical cash and it's value-based. So by contrast, bank deposits is an example of an account-based money, because when I deposit my £10 note with a bank, what effectively we're creating is an IOU from the bank to repay that £10 back to me when I want to withdraw the money from my account. And that sort of IOU, or the legal claim against the bank, is really only as good as the creditworthiness of the bank. And to some extent, this is ameliorated by national deposit insurance schemes like the SCS in the UK. But when we're talking about vast amounts of deposits, so institutional deposits, there is that credit risk.
So in contrast to, I think the previous panel who was talking around sort of cryptocurrencies, we can see a real difference between the types of currency that you and Robert have been talking about and cryptocurrencies, which broadly speaking are not value-based, they're not account-based, there's no issuer, and generally speaking, the value of that is dependent upon supply and demand. So it's a normal market asset as to where you have. So if you have a cryptocurrency, you might have bought it for £5, but it may equally go down to 10p, or it might go up to £2,500. So it's just a question as to how much people think it is worth. So really with central bank digital currencies, we're really talking about a sort of an amalgam of the first two sort of things you were talking around, value-based and account-based, I think, Gary, is that right?
Yeah, I mean, I think you would say that because it's central bank issued, there is value in it because it's backed by the government. But as Robert has suggested, a key distinguishing feature of digital currencies that it needs to mimic, sort of the anonymity of physical cash. So it's not account-based. Great.
Well, that all sounds great. Where do I sign up? Robert, can you sort of talk us through some of the trends? How soon is it before I can sign up to one of these things?
I think what what we're seeing are two, in terms of the underlying technology behind both cryptocurrency and distributed ledger technology, and it's the latter, distributed ledger technology, that is involved with developments around central bank digital currency. We are seeing two parallel trends within the application of this underlying technology. Cryptocurrency, the cryptocurrency space is evolving very, very quickly. It's very noisy and messy. The distributed ledger space is evolving also quickly, but within the context of financial institutions, and therefore has a different set of problems and constraints to work within. And central bank digital currency is not just a technology topic. It is a topic that involves legal and regulatory and macroeconomic topics as well. And as a result, I wouldn't expect to see central bank digital currency coming into existence anytime soon. But it is definitely a topic that is on the agenda, and it's a space to watch.
But there have been quite a lot of there's quite a lot of noise around it. There have been sort of various speeches from the ECB. Yves Mersch, I think, has made some speeches. There seem to be some other things happening around the globe. Any particular ones you'd like to sort of pick out?
Sure. So, I mean, there are a number of initiatives. First of all, I should say that the central banks have approached the CBDC topic from the perspective of research. So there are research programs going on in a number of central banks. There have also been pilot projects in the Bank of Canada, Project Jasper, a project in Singapore with MAS, and there's also, of course, the Utility Settlement Coin project, which we're involved in, which is a multi-jurisdictional project run by a consortium of banks and clearmatics. I think it's important to maybe give a little bit of context around why the CBDC topic matters, and it from the point of view of financial institutions. And it matters because central bank money plays a very special role within the capital market system of being a risk-free asset for the final settlement of cash. And central banks have been promoting the use of central bank money for settlement in financial market transactions for a long time, with a lot of progress. And the parallel topic of reforming financial market infrastructure with technology, and particularly distributed ledger technology, there is a very distinct risk that if a form of central bank money is not transferable on this new technology, that the progress that has been made in promoting central bank money in capital market settlements could go into reverse, and that the use of central bank money, just because of the use of commercial bank money for settlement, could become the default path for new forms of post-trade infrastructure, just because it's easier to put commercial bank money rather than central bank money on a distributed ledger.
So now turning to sort of some of the issues, should I say. Paul, could you take us through, so what's holding us back in this space at the moment? Why aren't we seeing more sort of finalized things? Why have we not got central bank digital currency as we speak at the moment?
Sure. Well, I mean, I think the sort of short answer is I think it's a moving, complex area that I think regulation and getting confidence around what is the right model to adopt is clearly a journey. As Robert mentioned, I mean, a lot of the sort of discussion points around CBDCs at the moment, HKMA have come out with a sort of research paper on this, is very much research backed at the moment. There's a lot of, clearly a path towards a trajectory of having something issued, but I think there's clearly a whole bunch of, clearly a lot of thinking that needs to go into this in terms of, first of all, the technology. So technology plays a key part of this. What actually is the platform within which this sort of sits? Is it distributed ledger technology? Is that the right method? What does that look like? Clearly different ways to build a protocol around DLT. So what is the right way of doing that would sort of enable this to happen properly, effectively? I think the other aspect, of course, is security. So lots of concerns around security, governance around this whole thing. Lots of issues really about the sort of way that participation can play a role either for the benefit or to the burden of the overall CBDC, and actually what is the right way to make sure that we've got good security around this. So those sorts of concerns, I think, are a lot of the things that are not necessarily holding things back, but things that need to be ironed out in clearly a great amount of detail, so that actually we can get to a position where a CBDC is robust enough to sort of go forward. I think obviously the other aspect for this is the sort of the micro and macro sort of economics around this, but also the micro and macro prudential regulation around this. So actually, what does that look like? And actually, this being a clearly sort of fundamental and systemic platform that will go in and sort of currency. I guess it's sort of what does that regulatory landscape look like? And clearly, the sort of central banks have got a clear role to play in actually trying to make sure this is fit for purpose in a clearly an evolving landscape. And I think those for me, I think were clearly the sort of key issues that certainly we've seen are cropping up. I know Gary, you might have some additional thoughts.
Yeah, I mean, I think there's, with all the will in the world, if central banks are able to resolve the policy dimensions to it, there's the practicalities of, how do we use existing systems to achieve these CBDCs? If to the extent they require any change, then that's clearly that the system changes are clearly going to take some time. And also there's probably a human social dimension to it. People are very familiar with physical cash and bank deposits and existing ways of using cash. If we were to introduce the CBDCs, I think that would also need some time for people to get comfortable with it and trust it.
So one of the points I'd like to just pick up that Gary was mentioning around the sort of the technological aspects of this. So clearly, to issue CBDC, you have to have a central bank system which actually facilitates that. And while, as Robert was saying, a lot of this has been done on a sort of research basis, and certainly to our eyes, it certainly looks as though central banks are being very neutral as to how this is achieved. They don't want to sort of plump for one particular option and make that the default option. So there are there's lots of optionality there, but there's also lots of, and I'm afraid here's the lawyer speaking, there are lots of legal and regulatory sort of issues around central bank digital currency. As you well know, the banking industry is very highly regulated, and just because you're issuing central bank digital currency doesn't mean that, or that there is central bank digital currency, doesn't mean that you're going to be outside of the regulatory net. So depending upon the structure in which the central bank digital currency is, in inverted commas, issued, you come up against a lot of regulatory hurdles, for example. So just looking at from the UK, informed by the European sphere, there are a number of things which you have to consider. So one of them is, are you going to be issuing a deposit? So if you have funds actually being provided to a bank, which then links back to the central bank, have you taken a deposit? So do you have to be a bank? Then there's a second one, which is, are you doing e-money? So, for example, if there is a token issued off the back of funds, again, coming from sort of companies or individuals, then that could be seen to be e-money. Again, you need to be regulated to provide e-money, and there are some other issues with e-money. You can't pay interest, so the central bank may be paying interest to the issuer, but the issuer then can't pay that back on to the holders of the token because they're prohibited by law from doing that. You may also have a payment service issue as well, as to whether you have created accounts through which you are ensuring payments go from one party to another. And then the system that is operating the distributed ledger technology, which is going to be used to support the CBDC, that again starts looking like a payment system, comes within the purview of the Bank of England or the relevant central bank. So there are a lot of regulatory hurdles here as well. None of them are necessarily insurmountable, but in order for people to be able to issue the type of central bank deposit that they really want, may require them either to compromise on how they want to achieve it, or to try and ensure that the laws change. And as we all know, change in the sort of the financial services world for legal backing can take really quite a long time. So certainly when I ask that question as to how soon are we going to see this, depending upon how radical the structure is that the entity wants to utilize to issue or get CBDC out there, we could be talking quite a long lead time given the legal and regulatory hurdles. So turning from there and just sort of more looking now, turning the lens on the banks. Thought I'd turn to you, Gary, and ask what are the banks seeing as the advantages of CBDC?
From a post-trade settlement perspective, I think there are at least two key benefits: risk reduction and capital velocity. So to take them in turn, risk reduction is to the point that Robert made earlier about removal of settlement risk. So if we're settling a sale of securities and we're able to receive the payment in CBDCs, which are central bank money, then we're settling in zero risk money. And also it's most likely to be capable of being instantaneous because it's digital. So that really takes us away from how securities tend to be settled these days, which can take time, and you could be settling in commercial bank money. Capital velocity, the other key benefit, is probably most apparent when we are sort of thinking about international FX payments. So we're sort of assuming a scenario where sufficient central banks have issued their own CBDCs and are interoperating in a way that allows me to swap a unit of sterling for a unit of for the equivalent unit of euro instantaneously. So money can then move very quickly, and we have that settlement finality on ledger if we're using DLT. So again, that's really speeding up the FX transaction process.
How about from your perspective, Paul? Any sort of additional observations on that?
No, certainly echo Gary's observation. I mean, I think all of the benefits that are coming through from the bank's perspective obviously lead to additional knock-on implications. So speed of transactions means that focus can be deployed to other sort of activities. It sort of means a better end customer sort of journey experience, sort of transactions, etc. So those sorts of benefits are clearly going to be seen to the end customer. So there's going to be a huge benefit. But I think the sort of cost and risk reduction, as Gary alluded to, I think that's clearly a huge benefit as well. So from savings of actual monies deployed to secure against certain risks, regulatory risks, other things, clearly going to be a sort of huge benefit for banks as sort of we move towards that.
And what about some of the use cases that banks are looking at? What are you looking at the moment?
Well, I think I'll sort of probably gloss over that slightly in terms of just giving a few examples of where we see good benefits, in terms of the technology and application. So I think it's primarily looking at what actually, to the original sort of opening really, about what actually is this in context, and where do we actually use or see what is the role of the bank within currency or money today. So international payments, for example, clearly a core use case that could be applied to this sort of settlement of securities and also intra sort of currency exchange. Those sorts of things I think are the core applications or use cases that certainly are being explored at the moment, areas where we can certainly see a lot of value and potential with CBDCs. Clearly there's a lot of exploration to go further, but I think those for me would be the sort of some of the three top areas of activity.
And Gary, anything you'd like to add to that?
No, I agree with what Paul has said. Yeah.
Okay, so I think sort of a final question for the panel. So, what do we think money's going to look like? I mean, in sort of 5 to 10 years' time. I mean, I'm always someone who feels a little bit safer when I've got some crinkly stuff in my wallet. Not if it's a £50 note. I get rather nervous if I've got one of those. But where do we think things are going to be in 5 to 10 years' time? Gary, do you want to kick off that one?
So it's probably quite obvious, but judging by my own addiction to using my phone to pay for most things rather than cash, I think there's going to be a further phasing out of physical cash. And I dare say sort of a continuing increase in mobile payments.
Paul?
I think in the short term, we're still going to have this sort of initial concept of transferring IOUs and generally the sort of concept of what money is currently. I think potentially we may see, I guess, a sort of a more fundamental shift towards an alternative payment mechanism, and I think that may be the future state. I think in the short term, I see, as Gary alluded to, I think the actual front-end application and usage of fast payments, mobile, digital journeys, those sorts of things, I think are probably the core sort of here and now, and then as we move towards something more radical potentially in the future, that's probably maybe where the shift will lead us towards. So
that sort of, in the short term, same delivery mechanisms, but just sort of slightly tinkering around the edges. Robert, do you have do you think there's going to be a generational change in the next 10 years as to how the actual delivery mechanism is going to change?
Yeah, I think it will change fundamentally, and I think we will see a continued phasing out of physical cash for a digital cash model. I don't know what the end state will look like, but I think the way I see it is that there is a fundamental tension in the way that fiat currency works and as fiat currency payments are settled today, and that is that you don't actually settle a payment in commercial bank money, even though most of the cash that we have in our that is in the system is commercial bank money. Final settlement always happens in central bank money, but only large commercial banks can have access to central bank money. So there will be no fundamental reform in the payment mechanism of fiat currency unless there is some form of central bank digital currency. So that is one trajectory that I could see happening over the 10-year horizon. If that doesn't happen, I would see a further iterations in the cryptocurrency space, which is really the only other alternative to final settlement in a credit risk-free digital cash instrument. And the tension between those two, I think, will sort of define how things evolve in the cash space. We'll definitely see a coexistence between cryptocurrency and fiat currency. But the space to watch is the evolution of central bank digital currency, I think.
Great. So we've got a couple of minutes left before we get unceremoniously kicked off. Are there any questions that people would like to raise? If you could wait for the mic, please. Yeah.
Hey, I've been trying to understand something. You said that central banks are only giving the new currency to commercial banks. And I was just wondering if one of these central banks experiments with a cryptocurrency, would it be possible for them to give a little bit of it to all the people instead of to banks through quantitative easing? I mean, just what would happen if one day everyone woke up with an extra $5,000 in a bank account? I think it'd be kind of interesting, and a lot more interesting than handing over billions in quantitative easing to banks. Now, I want to just kind of caveat this by saying I'm not very intelligent, I'm not very well read, so I'm trying to figure this out myself. Is that a stupid idea? And if not, do you think someone will do it?
Okay. It's not a stupid idea, and it is one of the most intelligent questions that I've heard in this space. It's one that everyone should ask: is why can't I have an account at the Bank of England, or why can't I have an account at the Fed, and what does it mean? And there are very big policy implications around that. The way this coexistence model between commercial bank money and central bank money, which is the defining feature of our monetary system, why it's like the way that it is a question that everyone should ask, because the answers are not simple, and the implications of changing that in fundamental ways are really quite large. That's not just about technology, and it's not just about law, and it's not just about capital markets.
From a legal perspective, you can't at the moment because their rules don't allow it. But policy reason, I mean, but that can be changed because they set their own rules. But at the moment, you can't. But as Robert was saying, it's more of a policy issue. Yeah.
I mean, I can fire up a decentralized bank on my laptop in the next 10 minutes and, start issuing Richard coin to anyone who wants some. But obviously, that's not necessarily the way to go. But I just think we're in this really interesting transition phase where central banks were really good for a reason, to kind of keep the ledger. But now that the ledger is decentralized, I'm just wondering what happens when everyone can print their own money.
Yeah, I mean, I think it's everyone can print their own money, but they can't. Only banks can print their own money legally. But if we let everyone become a bank, the rationing of the supply of the stuff that the printers of money, commercial banks, are obligated to convert into. So you can withdraw physical paper, because the paper notes you have in your wallet is central bank money. It's the only form of central bank money that non-banks can own. That has a way of restricting and rationing the supply. So the fundamental question is, like, who should be in control of the supply of that base money? And it's not just a simple, like, policy question of it should be the central bank, or maybe it should be the parliament, or maybe it should be all of us. It's a question of, there is this thing called a currency, which is this massive network effect. That's not just the cash instrument that we use as a medium of exchange, and it's not just the thing that we use as a store of value. It is the unit of account. The fact that people price their goods and transactions in your currency is the most powerful network effect around. And who gets to extract value from that network effect, and who has the governance over the maintenance of that network effect is a fundamentally political question that in a democracy we should all be asking.
I think I'm going to have to call a halt to it there. So thank you for your question. For those who do have some questions, I saw some other hands up. Do come and find us afterwards. I'd just like to thank my fellow panelists here, and I hope you all found that interesting. Thank you very much.